Each month, I'm adding $1,000 in a portfolio that I want to bring from zero in 2025 all the way up to $100,000 in 2031. Right now, I am almost at $10,000, so $9,700 by adding $1,000 per month at a 6.5% total return average. I should reach my goal by the end of 2031. So today we're going to take a look at the portfolio, where it's at, and we're also going to look at where my next $1,000 is going to go. And this one is a leader in Canada in its market. It has growth by acquisition as a growth vector, and it's a very interesting play for the future. But first, let's take a look at where I'm at right now. So portfolio is well diversified across many sectors, and this is usually a question that we receive where say, Mike, how can I build a portfolio by adding a few $100 per month, for example, to make it a little bit more diversified? So as you can see, I started this one at the beginning of the year, and every month I'm adding a new position until I get a fully diversified portfolio. But so far you can see that I have like 2 stocks in a few sectors, sometimes only 1, but overall I'm doing a pretty good job. So the total return since the beginning of the year is at 8.12%. So a little bit behind the market, but one thing that is important to consider is I don't have much banks in this one, only National Bank. And the other thing is I don't have that much gold. And those are the 2 things that is driving the market right now on the TSX. So that's why I'm a little bit behind. The average yield on the portfolio is at 1.5%. The 5 years average dividend growth rate is at 14.28. So very solid dividend growers here. And now we're going to add another $1,000 in this portfolio for December. And the drum roll, we're going to invest in financials. So Intact Financial, ticker IFC.TO, market cap of about $50 billion. The yield is about 1.88, so close to 2%. It's Canada's largest property and casualty insurance. So that's why you're going to see P&C. When you analyze a company like Intact Financial, you're going to see a lot of different abbreviation such as DPW, so it's direct premium written. And one other thing that's super important to understand is the combined ratio. So combined ratio is actually the claim ratio plus the expense ratio. So all the money that the insurer has to pay for claims and like the overhead cost of paying commissions and doing the business. And the combined ratio must be below 100% to make a profit. So for example, in Q3 of 2025, IFC reported a combined ratio of 89.8%, which means that for each dollar of premiums received, it costs 90 cents roughly to operate. So it's a good ratio. You can see that as pretty much like the margin of Intact Financial. So Intact operates mostly in Canada, where it's the largest P&C insurer. To give you an idea, the top 5 insurer covers about 47% of the market, and IFC as alone 17%. It's also present in the US and also in the UK and Ireland under RSA. The investment thesis for this one, well, first, the company benefits from scale and from a leadership perspective, so a little bit more of pricing power in Canada. As you can see on this graph, the company is growing a lot faster in terms of direct premium written, DPW, than the industry. So we're at 8% annualized growth rate since 2014 versus 6.6 for the industry. One thing that is super important in the insurance business is to have scale. Why? Because the more data you have, the more you can use AI on top of that to help you, and the better the premiums you can write, so you can actually show a better combined ratio. So the second part of this graph shows you the outperformance of the combined ratio for Intact versus the rest of the industry. So it's all possible because of that scale. The second growth vector for Intact Financial is the expansion in the UK business and also in the US. So as you can see in the UK, the combined ratio is pretty high versus what's happening in Canada and also in the US. So the goal here is to refine the contracts, make sure that they operate a little bit better so they can bring it back to 90% by the end of 2026 and therefore improve their profits. Same thing for the US. They have also PNC insurers over there. They're well on track with a low combined ratio under 90%, which means that they're making a lot more money on their premiums in the US versus in Canada. The last growth vector for Intact Financial is how they deploy their capital. So as you can see, over the past 10 years, they have invested over 19 billions and 65% of that was directed to acquisitions. So yes, they buy back shares a little bit. They pay you a great dividend, but most importantly, they focus on mergers and acquisition to gain that scale, as I told you before, to get more data, to write better premiums, and to show a better combined ratio. Now let's move on to the analysis of the dividend triangle. As you know, I focus on 3 simple metrics to see if the narrative I just told you makes sense in terms of numbers. So we're going to take a look at the revenue growth, the earnings per share growth, and of course, the dividend growth. So for Intact, it's always a bit difficult to analyze it because as you can see, they went through several acquisitions. So there was a big boost between 2020 to 2023 in terms of revenue. Same thing for earnings. But then between 23 and 24, we have not much revenue growth, but most importantly, earnings per share going down. And this is linked to major catastrophe losses. We're going to talk about that in the risk section, which is probably one of the largest risks for a PNC insurer, is you don't have any control over wildfires or any other natural catastrophes that could severely hurt your portfolio, while a lot of your clients can claim claims at the same time. In terms of the dividend growth, you can expect a high single-digit to double-digit dividend increase every single year. So it's pretty solid to be able to catch a stock that pays almost a 2% yield, but on top of that, will increase its dividend by 9 or 10% every single year moving forward. If you want to find other companies like Intact Financial with a robust dividend triangle, I made the list for you. So you can download the Rockstar list. It's a list of all the stocks that shows a positive dividend triangle. So revenue, earnings per share, and dividend growth over the past 5 years must be positive to be in that list. It's a great place to start your research. You can download it at dividendstocksrock.com/rockstar. All right, so nothing is perfect in this world. So we have to talk about the risk around Intact. There's always something going on here, right? There are 2 major risks in my opinion. The first one is, of course, natural catastrophes. So for example, in 2024, the company recorded 1.5 billion in losses related to the natural catastrophes. So it means that you have to write a lot of premiums and you have to make a lot of money to compensate for that loss. In 2025, the guidance at 1.2 billion, but it's always something that is really difficult to forecast because you never know how bad you're going to get hit by a wildfire. The other risk involved is, of course, the greater competitions the company faces in the US and also in UK and Ireland. So it's great to be the leader in Canada, but when you try to expand outside of the country, well, then you face a lot of bigger players. This will hurt the growth for direct premiums written, so the DPW, and it could slow down growth over time. So Intact must find a way to grow organically and also grow by mergers and acquisitions. So for the holidays, I'm going to take a few days off, fortunately, and I'm going to review all my investments. I'm going to use the global view in DSR Pro so I can see the sector allocation, the asset allocation, and the stock allocation I have across all the different portfolios I have, so I can make better choices in 2026. In January, when I will update this portfolio, I'm going to add an additional $2,000 because I've missed $2,000 investment in 2025, and I'm going to also invest another $1,000 for 2026. So you do not want to miss this video. All right, that's enough for today. Next week, we're going to talk about Canadian banks' earnings. They're all reporting between December 2nd and December 4th. So the 4th around 10 or 11-ish in the morning, I'll be able to publish the new video. Make sure that you subscribe to the channel to not miss it. And until then, don't forget to stay invested.